Hello and welcome to Market Wrap, a weekly update on equity markets and outlook for next week with Mr. Pankaj Pandey, Head Research, ICICI Direct. Very good morning, Pankaj, and thank you so much for taking out time.
Hi, good morning, Geetu.
Pankaj, markets still seem to be in a sell-on rise mode with Nifty once again nearing 17,400 levels, Sensex near 59,000 levels, nearly 2% shaved off for Bank Nifty this week. The market breadth is also working in favor of the bears. What are the chances that Nifty may surprise on the upside?
Well, Geetu, when you sort of look at last 14, 15 months, Nifty has been at similar levels of, say, 17,400, 500 kinds. And even when you look at from a Feb perspective, since Feb, the market has been in this range of, say, 17,200 to 17,800 kind of a range.
Right.
I think it is largely to do with the global cues. We are still seeing US job data being stronger and inflation is still sort of high. And which is why market is not able to take a directional view till the time any of the data sort of softens, because Fed continues to maintain a very hawkish stance. But having said that, this particular week we have seen Indian markets doing relatively better than what has happened in the US. So I think nothing much changes. I think this upcoming week will be a crucial week because you will have CPI numbers for India, for Europe, for US. Along with that, a lot of other economic data, be it retail sales or the housing start index and the PMI data. So obviously, if any of these data provides clues in terms of softening of the US economy, that can sort of provide a positive trigger. But on the other side, if any of these data continues to remain strong, then I think I'll not be surprised that the market stays in the range for some time.
Pankaj, if you expect the markets to stay in the range, what should the strategy be? And if there's some kind of a softness in the data and the markets start going higher, which are the sectors that you will keep in your focus?
So I think when you sort of look at the market off late, you are not getting very clean moves in the market. So you'll have some sectors performing for some period of time, and then you see sector rotation sort of panning out. So, for example, IT has sort of done well, but our sense is that probably banking and financial services could do relatively better. So, we have HDFC Bank, Axis Bank, SBI, or Bank of Baroda can sort of do well, because if there is a softness in interest rate, probably there will be little pressure on RBI to sort of go in for hiking rates. So, obviously, banking or capital or interest rate sensitive sectors can do well. We have already seen banking as a sector taking knock this week. Then I think capital goods looks more secular from the perspective that we have seen a good amount of allocation in the last few years budget. So this is one theme where things are looking a lot more better. Ideally, the margin profile also should improve. And then I think PSUs are looking a lot more better. I mean, you look at ONGC, you look at NTPC, all of them are sort of trading at quite cheaper valuation. And the perspective also is that things are looking better. So our sense is that power demand this summer is going to be all-time high, and NTPC will benefit from higher PLF. Same is the case with ONGC. If they are able to sort of explore more whales, which is what they are looking to do with a number of tie-ups, then the stock at 4 multiple looks attractive. So I think sector rotation is sort of panning out, and whichever segments haven't really sort of done well in the recent past, ideally should do well.
Pankaj, banks in US are started facing stress because of the high interest rates. We have no SVB like scenario in India. How strong are banks in India as far as the regulation? We understand that our banking system and the financial system is very well regulated, and the kinds of scenario that we're seeing in US might not happen in India. So banks are on the strong footing, but what is the kind of the rub-off that we saw in the banking space on Friday trading session? Will that continue?
So banks obviously are a sort of a barometer of sentiment. So if globally sentiments are down, especially because when you see the kind of interest rate hike which has happened in US, a lot of smaller banks can go belly up, which is what we are already sort of seeing, because in US it's very easy to load up asset and liabilities because all of these are sort of sold in tranches, and so you can sort of build asset and liability at a very fast pace because most of the assets are sort of securitized.
Right.
But unlike compared to that, India does not have India does not sort of follow that kind of a trend. So our
Okay.
sense is that you could have a sentimentally negative impact on the Indian banks, but as such, I think when you sort of look at, I mean, people, if investors look at your home loan rates have gone up by 200 bips. So banks are sort of pricing on all the kind of or repricing their asset depending on how the interest rates are moving. Like in US, where some of the banks are not able to do, and which is why they are sort of going belly up. So,
Mm-hmm.
so that kind of a risk is not there. But yes, if sentiments turns are, then obviously it will have implications for banks in terms of banks sort of underperforming, and
Mm-hmm.
vice versa. Also, if US Fed or if the data on inflation sort of cools off a bit, then I think
Mm-hmm.
banking is one sector which is probably going to outperform rest of the other sectors.
Mm-hmm. Mm-hmm. One of the sectors which has not been doing well lately in last 2 3 years is textile sector because of the high input cost, because of labor crisis, because of the export market not doing well. Now we are seeing a bit of traction coming back in this sector. So, what are the main reasons, and how do you see this sector performing?
So yes, textile value chain companies have been sort of impacted a lot because one, the cotton prices that rallied, I think, and they had a tough time in the last 3 4 quarters. But our sense is that now things are sort of shaping up well or relatively better because one, the domestic crop production is expected to be 5% higher. And as a result of that, we have seen cotton prices declining by 22, 23 odd percent. And see the biggest beneficiary of these will be spinning companies. So which is where we like two companies. One of them is Nitin Spinners. It's a pure spinning company with a capacity of about 3 lakh spindles. Now
Mm-hmm.
they have also sort of doing a forward integration in terms of more of woven fabrics and knitted fabrics. So which is
Mm-hmm.
25% of the portfolio and obviously fetches better margin. So our sense is that ROC of this company should improve from low double digits to mid double digits. So which
Mm-hmm.
is why we like this company with 290 price. And Vardhan is another company which has been the largest player on the spinning side,
Mm-hmm.
and they have been sort of operating at pretty high capacity utilization levels. And their
Mm-hmm.
capacity is nearly 4 times of Nitin Spinners. And our sense is
Okay.
that this is one company which also should benefit from this overall improvement in the spreads, especially on the spinning side. And here our target price is 345.
Mhm. One more sector which was lying very low was the sugar industry, sugar sector, where the stocks did not do well in 2022. Now we are talking about falling input, falling production, and monsoon crisis also. Do you expect this sector to now really see a bit of good traction and interest from the market participants?
Well, going by the historical trend where El Nino sort of happens, there is a 90% chance that the rainfall will be deficient. Now, that has implications for sugar as a sector because this is one crop which requires good amount of sugar. But however, the distribution or the impact is differently. So you will see sugar mills, especially in Maharashtra and Karnataka, getting impacted, and their production will get impacted. Contrary
Mhm.
to that, UP mills may not get impacted. So our sense is
Okay.
that there could be a production or production could be lowered by about to about 33.5 million tons compared to 36 million tons. And
Mhm.
with largely demand remaining same, you'll see a deficit or a shrinkage of the surplus of zero point 0.5 million tons. And historically, that has pushed prices by 2 3 rupees, and that
Okay.
should benefit UP-based sugar mill companies. Our sense is that companies like Dhampur Sugar, where our target price is 270, or Dalmia Bharat Sugar, where our target price is 490, could benefit
Mhm.
because one, we are seeing that these companies are witnessing a better sugar recovery, so their cost of production
Okay.
will be lower. And on top of it, if the sugar prices inch up, then these companies will be the biggest beneficiary.
Mhm. And on the other side, consumers like us will have to cut down on our sugar intake, right?
That's better from a health perspective.
True. Let's now talk about Tata Motors. Some more good news coming for the investors who have been waiting so long for this stock to really perform. Tata Technologies now plans to come out with IPO, value unlocking to be seen in Tata Motors. So how do you see this news really impacting the stock?
Well, Tata Motors, we are seeing multiple levers to sort of coming in to the benefit of the company. So one obviously is that you see that China has sort of opened up. So obviously demand from there is normalizing. And the worst is behind in terms of Europe. So that is another positive. And I think company has been very progressive in terms of debt reduction. One of the again steps is to sort of come up with an IPO for Tata Technologies. So they're looking to sell about 9.5 crore kind of a share, and about 8 crore share is going to be sold by Tata Motors. Now, our sense is that when you look at some of the R&D companies on the IT side, this company potentially could be a valuation, can fetch a valuation of about 20,000 odd crores. So with 74% kind of a stake, the value will be about 15,000 odd crores. So that will add about 40 rupees to our target price calculation. And again, they will get about 4,000 odd crores kind of a money, which obviously will be used towards debt reduction. So I think things are shaping up well for Tata Motors. A lot of the negative factors are now sort of turning positive for this company. So this is one company which we like and hasn't really sort of done much in terms of price performance, which is why we feel that next 1 year, in terms of sector rotation, also this stock can benefit with a target price of 530. So this is one of a better pick in the entire auto as a space as of now.
Pankaj, we all know that government's focus has been on infrastructure, and now with main election, general elections coming next year, the road construction will pick up, and it has been doing well under Mr. Gadkari. How do you see road construction companies placed when there will be higher spend from the government?
So one is the government had, when you sort of look at last few years, the capex allocation towards the road has been one of the highest. So you have seen 25% CAGR. And this year, the plan was to award about 12,000 odd kilometers kind of a road. But 9 months, we have seen only awarding of, say, 7,200. So, which is why it was giving a feeling that probably things are not really well on the ordering side. But I think what we are seeing is that the ordering trend is sort of picking up, especially in this quarter. So our sense is that about 100 odd projects with a total order value of about 1.1 lakh crore could get awarded in the next 2 months, and 10 projects have already come in. So we are already seeing news of companies winning road patches in the recent news. And our sense is that most of these companies are well placed in terms of the order book to bill, but the recent or the new order wins are important for the sustainability of revenues beyond FY25. And which is why we feel that companies like, say, PNC Infra, where our target price is 490, should benefit. HEG Infra with a target price of 915 and GR Infra with a target price of 1400. So I think road is one space where news flows are turning positive, especially in terms of order wins. And our sense is that this segment hasn't really done much in terms of price performance, but now it should do that catch up.
Inflation still at elevated levels that we spoke about just now. Do you expect real estate sector to get hurt as far as the demand is concerned? Because we are not expecting inflation to cool off anytime soon, and we are still expecting the rates to go higher.
Well, there is a divergence here. So when you sort of look at from a price performance perspective, while Nifty is up 5% in the last 1 year, the real estate as the index is down about 6 odd percent. And this is because of the fact that the home loan rates have gone up by at least 200 bips for most of the borrowers. But when you sort of look at from a demand perspective, for top 7 cities, the housing sales have gone up by 54 odd percent in calendar year 22. And so from that perspective, demand still continues to remain strong. Q4 last quarter was also sort of healthy. But now you're seeing some bit of a moderation. So there is a moderation seen in one of the biggest market, which is Mumbai. So registrations have declined by 11% in the month of Feb. Similarly, I think budget also had capped the deduction on the capital gains to about 10 odd crores. So as a result of that, there could be some moderation in demand, which is why the real estate as an index is down 6 odd percent. But our sense is that when you sort of look at the texture of the industry, what is happening is that the smaller players are still getting impacted because for them, if debt to equity is high, so then the challenges are for them quite high. Compared to that, organized players are still sort of doing better, and which is why I feel that you'll against because of this you'll see a shift towards more of organized player, which has been the trend since the RERA introduction. So I think the organized or the listed players in key markets like Bengaluru, Pune, Hyderabad should do well. And from that perspective, I think Brigade Enterprises remains our top pick with a target price of 620. This is one of the few companies where you really do not have material debt on the residential side. Ideally, on the residential side, you don't need debt because most of the money is paid sort of upfront, unless the money is utilized somewhere else. So that way, I think this is one of the cleanest companies which we like in the real estate space.
Pankaj, we had a piece of news from Adani Group late evening yesterday, where they're talking about selling stake in the cement business. If that happens, what is the kind of impact that you see for companies like ACC and Ambuja and overall cement space?
So for overall cement space, it does not have much of an implication, except for the fact that if the promoters are able to sort of deleverage, then they'll continue to sort of double their capacity. So that is what the entire intent, even before this issue, that to grow the capacity by 15, 16 odd percent. So industry-wide, there's no major implication. But I think when you sort of look at from a company perspective, if they are able to raise money of about $500 million, then they can sort of significantly deleverage at least at the promoter entity level. And if they are able to get a good investor, I think this is one big positive news for ACC and Ambuja combined, because when you sort of look at their peers, they're trading at 20-30% higher P multiples or valuation multiples. Compared to that, these companies have been sort of subdued. So I think specifically to both ACC and Ambuja, this is a very, if this happens, I think this is a very positive news which can come by. Because there is a lot more room to sort of catch up in terms of valuation. Q4 numbers, we will in general expect industry to sort of do well, because power and fuel cost is expected to sort of soften, and then companies have taken some bit of a price hike. So I think it's a good news overall for ACC and Ambuja combined.
Now it's the time for Hidden Gems. So which is a stock that you are going to talk about today?
So what we're seeing is that there's some sector rotation which is happening. So one is, say, 2020, you had pharma doing well, 21, IT did well, then 22, banking did well. I think capital goods is one sector which ideally should do well given the overall focus, and which is why I'm highlighting a company called KSB Limited. The previous name was KSB Pumps. This company manufactures standard industrial pumps, and then they also make engineered pumps. So basically customizable pumps, and with a clientele of say BHEL, Thermax, L&T, NTPC, Thyssen Group. So standard pumps contribute nearly 45 to 48% of the turnover, and engineered pumps is about 25%. And then you have walls, which are also sort of as a segment contributing about 18 to 20% of the revenues. Now, this company is a good play on nuclear power, petrochemical segment, railways, especially Vande Bharat and locomotives, and the mechanical segment. So I think this company has been focusing more, and our sense is that company will continue to grow at say 18% in terms of top line. And with a better margin, the profit could grow at about 22 odd percent. So I think this is one company which is looking good. It's an MNC company where our target price is 2395. So our sense is that it's in a sweet spot, given the fact that now government is also focusing a lot more on the nuclear power.
So the hidden gem for this week is KSB Pumps, where with target of 2395. An upside of 15%. So Pankaj, how would you approach the markets for next week? What is that we should expect from Nifty and Sensex?
So we are at the mid level of 17,200 to 17,800 kind of overall range for the market, and you have key data events lined up. Like I said, you have CPI domestically, which will come by. Then you have US CPI numbers which will come, and you will have Europe CPI numbers. Along with that, you will have other retail sales for US PMI index. So a lot of economic data releases are there. And obviously, all these events are very important data events, which are going to sort of directionally decide which way the market will sort of come by. So I would still stick with a sort of a range because US data, contrary to what people have been anticipating, is not really sort of coming on the expected lines. So I'm also keeping my fingers crossed that the data does not sort of disappoint. Because our sense is that if it sort of disappoints, probably market will be stuck in a range. If there is some relief on the data front, and the market would inch towards 17,800. So 17,800, if it is able to sustain, then only we are be able to break out this consolidation mold, which has been going on for quite some time.
Thank you so much, Pankaj, for taking out time from your busy schedule, and we wish you a great day ahead.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.